Hello and welcome everyone to the fifth session in the G100 PwC Future of the Profession series. I'm Martin Roberts, Chair of the Group of 100 and also Group CFO for Ramsay Healthcare. So far in this series, we've covered digitisation, finance function transformation, emerging skills, and upskilling. In the last session was about future of work. In today's session, we're focused on M&A and the trends and what this means for CFOs in Australia. After a record-breaking year in 2021 for M&A, what does it look like for 2022 and beyond? Our panel today will cover M&A trends, lessons learned for CFOs and finance teams need to know to ensure value creation and a successful transaction. I'm really looking forward to today's session. I'm sure we'll hear some interesting perspectives from our panel gathered here today. Before we start, I'd like to open with an acknowledgement of country. We acknowledge and pay our respects to Aboriginal and Torres Strait Islander peoples as the first peoples of Australia, whose ancestral lands and waters we work and live on throughout Australia. We honour the wisdom of and pay respect to elders past, present and future. I'm pleased to introduce you to the host of today's webinar, Chris Dodd. Chris is the Strategy and Markets Leader for PwC's assurance business and works extensively with ASX-listed companies. Over to you, Chris.
Thanks, Martin. Thanks for that introduction and welcome everybody back to our Future of the Profession series. It's great to be here, and I'm stepping in today on behalf of Sam Lobley, who many of you would know as the leader of this working group with the G100. And we send our thoughts and best wishes out to Sam, who's had a loss in the family late last week. So hoping Sam is doing well and hope we can fill his admirable shoes well. So thanks for joining us. It's terrific to have you all here today. And we're looking forward to unpicking where the world is at from an M&A perspective. I'm joined by some terrific speakers, and we're really looking at how do we think through the world of M&A through the eyes of the CFO, and how do they think about bringing value to the entire organisation, as well as the role they have to play themselves. So you've already heard from Martin that's been a record year in M&A, and we're going to talk about whether that trend will continue. And we're going to look at some of the macro and micro issues that are unpacking in there. So I'm joined today by a number of terrific speakers. Clara Cutajar joins us as one of the senior partners from the PwC deals team. Marcus Oskarsson joins us as from Brookfield. Stuart Hooper, CFO of Ventia. And from our Melbourne studio, no less, we've got Amanda Sellars, CFO of Asahi Beverages. And we look forward to what they have to speak about. What we'll actually get Clara and Marcus to do is delve a little deeper into the macro trends that are going on in the M&A space. And then we'll get both Stu and Amanda to talk about some of the specific issues they've been dealing with and how they might play out into the role of CFO. And then we'll turn it over to you, because importantly, this is a conversation that we want you to be involved in. If you glance down to your bottom left hand of your screen at the moment, I hope you see a text box there. We're open to any number of questions that you might like to ask, and we'll moderate those as a panel at the end of our presentations. If you can put those questions in any time as we travel through, but if there's someone specific you'd like to answer the question, please also add their name into the comment box, and we'll make sure we direct it in that way. Otherwise, we'll see who's best placed to answer, and we'll have some fun. So without any further ado, why don't we get stuck into our key topics? And I will first pass over to my fellow partner, Clara Cutajar from here at PwC. Clara works closely in our deals teams, worked in deals across the planet here in Australia, the UK and the US, and has worked on both strategic and financial deals, and assisted clients on transactions ranging from 5 million to as high as 30 billion over a diverse range of industries. Clara has provided advice both on the sell side and buy side of transactions, so can see both sides of that as it plays out, and a lot of public document transactions, including IPOs and demergers, that we'll cover off a bit today as well. Importantly, of course, Clara has 2 German Shepherds, Fritz and Kaiser, and you can often see them taking Clara for a walk around Sydney. Clara, please, over to you.
Thanks, Chris. It's really exciting to be here today to talk to everybody about the trends and what's happening in our market. So firstly, I just wanted to kick off the session with a bit of an overarching view on what are the key M&A trends that are impacting our market. And as we've heard from everyone, it has been a very hot market. So we're coming off 2021, which was a very hot market for M&A, being described as a frenzy of activity. And for those that were living it, it certainly did feel like somewhat of a frenzy. So I just wanted to kick off firstly on some of the overarching trends. So because of the amount and why was that frenzy caused? So I think, as we're all aware, there is a significant amount of capital in the market, and that ranges from sitting in sovereign wealth funds, private equity funds, and corporates. Significant wall of capital that needs to be deployed into the market. And so all that capital is looking for a home. And so that's driven really competitive processes, really competitive transaction processes, really high valuations on a number of processes. In the Australian market, we've seen that play out pretty significantly. There have been a number of public to private transactions, probably more so than a lot of other markets. There have been some absolute mega deals that have been performed in that forum. So the Sydney Airport transaction, the AusNet transaction as well, was performed as a public to private takeover. And the other thing that we've also seen is a trend is that I think a lot of companies and a lot of investors potentially don't want to play the roulette of a sort of public process, and with the significant valuations that are being paid, are looking for more for strategic opportunities, more opportunities to be in a private process, negotiate an exclusive and get into those processes. The other thing that I think CFOs need to consider is that processes can happen very quickly. Because of the time frame and the competitiveness of processes, they're very quick, and so you need to be prepared as a CFO in terms of your overarching diligence process. And the complexity of processes is obviously expands as we move into being more competitive. The other question is, will there be some opportunity with governments? So I think we're all aware that our governments have put in a lot of money into the economy through COVID stimulus, and will they continue to pay for everything? I think we're all aware of our government debt, and it's reached all-time highs in terms of the level of government debt. And so will that create more opportunities for the private sector to partner with government? And that could be through asset sales. It could be through contestability of government services, or it could be through just partnering with the government sector. So that is an area that will be interesting to see how that plays out across our sort of federal and state governments. The third piece is around companies looking to acquire digital capability, and we've certainly seen that play out in terms of globally and here in Australia, and then how ESG plays into that platform. So ESG is obviously starting to play out, and some sectors more heavily playing out than others. And we've seen M&A take place as part of that sort of ESG evolution, where companies are looking to evolve their M&A strategy and move into different types of operating. So an example of that is this year, where Shell acquired the Meridian Retail Energy portfolio as an evolution of their strategy. And then I think we've heard that there is significant amount of dry powder out there, significant amount of capital to be deployed by private equity, sovereign wealth funds. And so that will continue, I guess, as a wave of activity in the market. And the final piece is around IPOs. So in 2021, we did see a significant amount of IPO activity. I think at one stage we were working on 17 IPOs, which is pretty astronomical. That market seems to have slowed down a little bit this year, and there's obviously a lot of things happening globally that create some uncertainty in the market. So the IPO activity has certainly slowed down, potentially partly because of the high multiples that are being paid on transaction activity and the risk that gets taken on when you IPO. So that market has slowed down somewhat. Next slide, please. The next slide just takes over, does a bit of a high run through of the various sectors. I think the summary of this slide is pretty much transaction activity across all sectors. The only one sector where there is some doubt is the retail sector. The retail sector did have some headwinds coming into COVID, obviously significantly more headwinds as we moved into COVID. And so there are some question marks about certain parts of that sector in terms of investing. But otherwise, all sectors have various elements driving the activity. Might leave it there. Thank you. Over to you, Chris.
Thanks, Clara. Thanks for that presentation. And I've thought a couple of things in there. One was the increase to the move to private, and particularly from an Australian point of view, that we have seen that trend quite a bit, and interesting, sort of almost creates another option for our companies here. And the other is just that ever-increasing influence of ESG as it plays out. It's becoming more and more a part of deals as we see them play out, isn't it?
Yeah, and I think we as a country have been potentially a little bit slow to adopt the ESG sort of strategies, and, you know, partly caused by our somewhat uncertain federal policies around ESG. And energy policy, but it is now starting to weigh heavily on the minds of a number of boards and a number of companies as to how they implement ESG as part of their day-to-day.
Yeah, got it. Thank you. So move on to our next speaker, and Marcus Oskarsson joins us as the VP of Brookfield Asset Management. And Marcus, particularly great to have you here today. Thank you for joining us. Marcus brings 12 years of experience in private equity and investment banking in Sydney, London and the Nordic region, with his main focus on large cap industrials and services businesses. He previously worked as a financial news reporter during university and covered the Swedish industrial sector, so we might get to there in Q&A, Marcus. He's also a passionate skier and snowboarder, and like so many of us, he's just waiting for borders to open and potentially get to Japan this Christmas. So we wish you well with that, Marcus. But over to you, my friend.
Thanks a lot for the kind words, Chris, and really nice to be here today. I thought I would start before I go into the topic of M&A, just to give a brief introduction of Brookfield, as I'm hoping that I will meet a lot of you over the coming years. And we jokingly used to say that Brookfield is to the extent you haven't heard of us before, we used to say that we're probably the largest company in the world that you've never heard of. And whilst that has been the case in the past, we find it harder and harder to stay out of the public limelight as we grow. And you've probably seen our name in the media over the last few months. But we are a large global investor into real assets. We have $700 billion under management globally. And across 5 verticals, I'm representing the private equity vertical. So I'll share that lens with you here today. And in particular in Australia and New Zealand, we have just over $35 billion of assets under management, 30,000 employees across our portfolio companies in the region. And we hope we'll increase that significantly over the next few years. Next slide, please. But then over to the key topic of today, and M&A, value creation through M&A. I thought I would just start by sharing a tool set we use when we assess opportunities, and that's the formula of return on invested capital. If I had an hour, which I haven't been given today, I'd happily take you through all the intricacies of this formula. But if you haven't come across it before, I welcome you to look it up after this session. But if you look at this formula, there is essentially 3 sources of value creation as you think about M&A. Price you pay, the amount of synergies you achieve, and the cost of capital. Today, I want to focus on synergies because, as Clara alluded to, price these days, there's so much capital around, so it's unlikely that will be a source of value creation for you. For any given transaction opportunity, there will most likely be a competitor that will run alongside you to try to buy these assets. Cost of capital with a low interest rate environment is not a source of strategic value anymore. Gone are the days when, say, Japanese corporates could pay immensely more than Australian corporates due to a cost of capital advantage. So then we're on to synergies, and that's really the sole strategic advantage that corporate buyers have over the likes of people like us that are financial investors. And as we have looked at a number of companies across all sectors in Australia, the key takeaways I have that I wanted to share with you today is that as you think about synergies, that is really the be-all, end-all of value creation through M&A. And when you look at new transactions, the first question you need to ask yourself is this of strategic value to my company? Because if it is not, you're not going to achieve any synergies. So then you're unlikely going to create any value. And then secondly, if there are synergies to be achieved from this transaction, how much of that will you have to pay away in the purchase price? Because there is no point in paying away at all, because that's not creating value for your shareholders. And thirdly is overestimating your capability and the time it will take to deliver on those synergies. And I've got two examples of one very successful value creation M&A strategy and the opposite that I wanted to share with you without naming any names. But in the first instance, this is a company that is valued around 7 times EBITDA. They embarked on a large bolt-on a couple of years back. They paid 7 times EBITDA, and the business was doing $50 million of EBITDA. So a net neutral transaction. But through that acquisition, they achieved $100 million of synergies. So in essence, they were paying less than 3 times EBITDA. Clearly a large source of value creation. And then on the flip side, another company we looked very closely at, who was trading at around 7 times EBITDA, that just decided to buy an even larger company than themselves. And they paid 10 times EBITDA, including the synergies they estimated. So they paid away more than 100% of the synergies they thought they would achieve. And what happened was that the market really didn't like this transaction. They thought they overpaid. And secondly, they couldn't deliver on the synergies. And now they're a former shadow of itself. Share price is down 70%, and they took a $200 million write-down last year. Next slide, please. And I thought I would just share some empirical studies we've done ahead of this session today on value creation amongst ASX 200 listed companies, amongst the ones that pursued M&A versus the ones that didn't. And against theory, I think the key takeaway is that most of the companies on average actually did not create value for the shareholders that embarked on M&A, which goes against theory, but it just shows that people were just overlooking the synergies or paying away too many of them, and ultimately paid too much when they acquired the company. Maybe they got into that Dutch auction and winner's curse situation, but it just shows how disciplined you need to be when you approach M&A opportunities. So that's what I really wanted to leave with you today, is really assess the acquisition on its own merit and how much synergies you actually can derive from the acquisition. Looking forward to more questions around it later.
Thanks, Marcus. A lot of great things to think about in there. I thought you brought out very nicely the fact that both price and cost of capital are just not spaces that are necessarily going to drive value anymore. By all means, grab them if you can, but it is getting harder. And just that lesson learned around, synergies are where the value is going to come from. So don't bid them away as the exercise unfolds.
Yes, and the sell side advisors these days are very good at extracting as high price as they can. So if they can extract all the synergies out of you, they will.
Perfect. So if I could just thank Marcus, but also remind you that if any questions you've got for Marcus, please reach down to that text box down the left-hand side and start bringing those together. If you'd like to leave Marcus your number for something that you'd like to transact on shortly, I'm sure he'd be happy to hear from you as well. He said he hoped he'd meet a lot of you in the future. So let's give you both of those options. Why don't we pass now to our next speaker, and Stuart Hooper joins us from Ventia, where he's the CFO. He has been the CFO at Ventia for over 4 years, having joined initially to lead their strategy and corporate development team. as they brought together the integration of 3 operating divisions that were divested from Leighton Holdings, which of course is now CIMIC. Prior to Ventia, Stuart actually worked for PwC, leading deals teams on both buy-side and sell-side transactions in Australia and the US. I know Stuart and his wife, Dina, have 3 young kids and enjoy splitting their time between Sydney, Melbourne, and what I would call a very strategic farm in South Gippsland, where it provides particular synergies during lockdown. Stuart, with that backdrop, over to you, my friend.
Thanks very much, Chris. Look, I thought I'd start with just a bit of background on the Ventia business. Similar to Marcus, I think, Ventia is a large organisation, but not very well known. And so I just wanted to provide a bit of background on how this business has come together. I mean, the key thing is that really Ventia is the sum of some quite significant parts, and it's through a series of acquisitions that we've been able to build a business in now of just around $5 billion of revenue scale. So I joined the business back in early 2015, and as Chris said, after leaving PwC, and at that time we were bringing together 3 operating divisions out of Leighton. What was interesting about that transaction was they were just the operating divisions themselves. So all of the corporate infrastructure, the IT systems, all the business processes remained with the legacy entities. So we had a 12-month TSA to basically stand up all brand new systems. And I think what was interesting during that period was, that is a huge task to move off, 4 different ERPs, get onto a single platform. And really as a result, I'd say that from an integration perspective, it kind of went in pretty hard. And as a result, it took 2 or 3 years to then mature those platforms. And then, ultimately for us, that is a lot of work that you're doing, almost going back and retrofitting the integration of those businesses. Roll forward a few years to back end of 2019, we signed a deal to buy the Broad Spectrum business, previously known as Transfield Services, a large, stable organisation, about $2.5 billion in size from a turnover perspective, and a very, very different scenario. Very strong through the back end. There had been a lot of money invested over a long period of time in both systems, business processes, and really having the whole organisation on a single operating platform. And there's huge advantage, huge operating leverage that comes from that type of platform. And it was really attractive to us, not just as it relates to synergies and as Marcus described, the opportunity for us to build value that way, but also to mature our own business, which we could see, there was opportunity to take on some of those broad spectrum systems and processes to improve the operating performance of our own business. Roll forward a couple more years, and now into 2021, quite a busy year. So we started off the year with a divestment of a business called APP. It was a consulting business, but it wasn't on strategy. You could see it didn't fit the operating model overall. It's still a great business, but not in our hands. So that was something which we divested. And then we get towards the back of the year, we undertook an IPO through really the back half of 2021. And we also took on a bolt-on at the same time. So a small business called Cordia, turns out about 130 million, but a really nice fit with our broader telco business. And you brought in new capability, existing client relationships, but very much was in line and fitted the model that we have from a broader operating perspective. The IPO itself was a huge undertaking. I think as anyone out there knows who's gone through a similar experience, very much a long process, a lot of work that goes into the financials, the development of those, and I suppose further complicated by, a COVID year and some of the impacts as it relates to forecasts and where we thought it would go. During the book build period and towards the back end of the book build, we had to change course a little bit, and we decided to reduce the overall sell down from about 50% to 30% and remove the secondary from the IPO. And that was very much about meeting the objective of getting listed, and in some ways, saving for the future as it relates to the overall value creation for a number of the existing shareholders. I'll just go to the next slide, please. So just a couple more stats just on the business. As I said, about a $5 billion organisation, about 16.8 billion of work in hand or order book, and we had a really successful 2021. So we won about 8.2 billion of work in 2021, and it was almost perfect timing as it relates to an IPO process, but also probably met with some skepticism about, are you winning that work at the right margins, or is this a dress up for an IPO? I can confidently say we were winning at the right margins. Those contracts have successfully mobilised, and it's obviously been successful from that perspective. To deliver that amount of work, we've got a workforce of about 35,000 people, and about half of those are employees, half are subcontractors. But just to bring it to life a little bit more, I think very much Ventia is in the background. In the background, providing essential services on critical infrastructure, and really with where I'm sitting here today in Sydney, there's a range of things we're doing which you probably don't see on a day-to-day basis. But when you turn on a tap, the Sydney water network, Ventia maintains, whether that's the pipe networks, the pump houses, etc., that get that water to your house. Whether you're dropping the kids at school, the cleaning contracts that we have are in place, obviously through a COVID period with deep sanitisation and other requirements, significant amount of work in that space. When you're driving to work through the different motorways and tunnels around Sydney, Ventia maintains those, operates those tunnels with Transurban. And then if you step out of here in the city, which we're sitting in right now, we do an integrated FM contract for the City of Sydney, and that's looking after their some 270 buildings, all the artworks that are in the streets, parks, gardens, etc. So a very broad range of services. Just finally, Barangaroo, where the PwC building here is in Sydney, it used to be quite a toxic site, and there was a significant amount of remediation that had to be done. Our environmental services business was able to step in, clean up the land for better use, and then enabled the development of this site. Just finally, I've mentioned the telco business, and we've done a significant amount of work installing the NBN, both really up and down the east coast of Australia. So when you're sitting at home watching Netflix or whatever takes your fancy, that in the background there, Ventia has often installed the NBN for that particular service. If I could just move to my next slide, please. Just a couple of learnings. So, there's a lot we've gone through as an organisation. I think as it relates to getting external advice, particularly financial advisory, it's something which we've definitely used on some transactions, but for the broad spectrum transaction, which was large in scale, we basically self-advised. Significant undertaking is, I think, the thing I'd say from the outset, that you do see real alignment between people who are undertaking the work on the transactions, the deal team, who then become the integration team, who are then brought into delivering on synergies, delivering on the value from the transaction. So that was quite a really good thing that came out of doing that. That said, the pressure on the deal team when weeks turned into months and months turns into half a year, that is a lot to take on from a personal perspective. Just around expectation management, and this sort of goes to a broader thesis around doing deals, which is you do have to see value in the deal. Not everything's going to go your way. There'll always be things that will pop up and that you weren't expecting. And so you want to leave yourself some room. You want to make sure that you haven't, to Marcus's points, built in everything, including every last available synergy. You're going to need some of that for the things that you didn't expect. Due diligence goes without saying, significant and important to both establishing the deal thesis, but ensuring you're going to deliver the value of the transaction. One thing I would say, though, we don't rely on W&I insurance where we can, and we have used that in transactions. We really want to understand what the risks are in the business, and we want to make sure that we've got mitigations in place to manage those risks. So it's an important thing that we focus on. Good culture, it's very easy to say. I think, that some of the more sort of structural aspects of deal making, so putting an operating model in place, driving an organisational structure and, system changes, you can build a process around that. You can get the right people involved to make that happen. Cultural change is hard. What you're looking for to get people aligned around a single strategy, it has to be simple, easily understood, and then you've got to really onboard everyone to a single set of values as an organisation and then stand by that. A couple of final points, integrations, if you do them fast, I think you'll be successful. What we've seen, particularly with the broad spectrum acquisition, was really quite a snap to grid style approach. We had a good amount of time to plan. And what that meant was real certainty for people. And it makes a huge difference because with uncertainty, people are always second guessing what's going to happen and you lose focus on driving the operations of the business. So snap to grid, within a quarter, everyone knew what their future role was going to be, or if they didn't have a role with the organisation, I think that made a huge difference. both to synergies, but also to forward momentum. And then just finally, communication. So, it seems like an obvious point, but just having the deal team come together for a stand-up every morning, a lot happens in 24 hours. And I think, when you think about the effort that people are putting in and that discretionary effort, it really buys them into what you're trying to achieve as an organisation. And as a result, they get rewarded and they get good outcomes from that. So communication's key. Thanks, Chris.
Thank you, Stu. Terrific. I can almost hear Maxwell Smart talking about the old 12-month TSA trick. That's the third time I've fallen for that this month.
Yeah, exactly.
It's 12 months is never enough, is it? It's almost not even worth talking 12.
No, that's right.
The other thing I wanted to pick up, you've flagged culture, and I think Amanda will talk a little about that shortly, but we could almost have a separate session on the culture impacts from a deals perspective. Just interested as a CFO, I think you're actually in a unique spot to sort of help to influence where is that culture, how is it meshing, how is it coming together. That feels like a role you really need to play.
Yeah, absolutely. And I think you can sit behind a strategy, but more than that, I think you need to also just think about the broader operating model, being really clear about what people are doing in different parts of the business and why. And then I think it does start to then resonate with culture growth over time, but it all takes time. It doesn't just happen. And we talk about 12-month, 18-month periods. It's definitely the long haul.
Yeah. No, great. Thank you. Some great insights there, and hopefully some things for people to reflect on. I'm sure we've got plenty of G100s who are listed, but I'm sure they're also living through lots of similar experiences. So great to have that insight. I'm going to turn to our Melbourne studios now, and joining us there is Amanda Sellars, the Chief Financial Officer of Asahi Beverages, Oceania. Welcome, Amanda.
Thank you, Chris.
Just a delicate way of checking the technology's working as we do that. So glad to see you nodding. That's a great start. Amanda's has overseen a number of mergers, acquisitions, and in fact demergers, and so different stories to tell on all fronts, and brings a wealth of experience in those business operations both here in Australia and internationally. Her previous experience includes divisional CFO roles at Treasury Wines, at Transurban Group, and at Foster's Group. So fair to say now that she's back at Asahi, where Foster's has found itself, all roads lead to CUB for Amanda. They come around quite often. Sorry, I had to get one dad joke into the presentation. Amanda's also a director of the Australian Red Cross Lifeblood, and enjoys giving back to the community through that form, and also through many of her on and off field sporting pursuits. So, Amanda, welcome to you, and please share your slides.
Great. Thank you very much, Chris, and thanks for the opportunity to present today. I'll just move to the first slide, and similar to Marcus and Stuart, we'll just provide a little bit of an overview of who Asahi Beverages are. So Asahi Beverages operates in the Oceania region, so predominantly across Australia and New Zealand, and we're a whole and Asahi Group holdings are listed on the Tokyo Stock Exchange in Japan. As you can see there on the left-hand side of the slide, we came together and formed in 2009, initially with the acquisition of Schweppes Australia, which is a non-alcohol business. Obviously Schweppes, but many other brands that you would recognise in that portfolio as well. And during that foundational period, went on to acquire other beverage companies and brands across Australia and New Zealand. After that period of time, we went on to acquire and extend the portfolio with further craft acquisitions, and we also entered into key long-term beverage partnerships. And some of our key partners include companies like PepsiCo and Treasury Wine Estates in New Zealand. More recently, in 2019, we announced the acquisition, as Chris mentioned, of Carlton and United Breweries, or CUB as it is known, and that was certainly by far and away the largest acquisition that Asahi Group Holdings had made in the Oceania region. We acquired CUB for 16 billion Australian dollars, which doubled the size of the Oceania region and gave Asahi a leadership position in Australia across many categories, including beer and cider. More recently, in 2021, we also went on to acquire an interest in coffee with the acquisition of All Press. It was interesting for us, the acquisition of CUB settled in mid-2020. And for those of you Melbourne-based, that was obviously right in the middle of one of our first lockdowns across Victoria. So we had to not only onboard all of the CUB employees, but also establish what we called Alliance for Growth, which was broader than an integration program. And I'll talk about that in a little bit more detail in a moment, but we also obviously had to underpin and set up our new operating model throughout the Oceania region, including some of the things that Stuart discussed around system and process optimisation. If we just move to the next slide, in terms of sort of deal rationale, first and foremost, the acquisition of CUB was very much on point with our worldwide Asahi Group philosophy. So being a value creator globally and locally, growing with high value-add brands. And certainly CUB has a high track record of sustainable growth and a very strong portfolio, predominantly in beer and cider. The acquisition was seen as being very complementary to our existing business here in Oceania, both in terms of our market presence, but also in terms of the portfolio that CUB brought to the Asahi Beverages region. And it also provides, importantly, scale. So we now are one of the largest regions within the Asahi Group Holdings total network. So there's 3 pillars: Oceania, which is the business I'm talking to you about today, a European business, and also a business headquartered in Japan. We also see CUB as bringing market-leading capability, particularly in marketing and new product development. And I think you will be familiar with some of our brands, but also the innovation that CUB has brought to market. And one of those great success stories is, of course, the Great Northern brand. But not only does CUB have a strong portfolio, they also have a strong network, as does the Asahi Beverages business. So bringing those networks together to be able to optimise our total business operations and allow us efficiencies was also key to this strategy. If we just turn to the final slide, just touching on some of the efficiencies identified as part of the deal. It was really twofold. It was leveraging our existing scale in the Oceania region, but it was also about bringing our 2 alcohol business divisions together. So in the Oceania region now, we operate 3 business divisions. We operate an alcohol business division, now known as CUB. We operate a non-alcohol business division known as Asahi Lifestyle Beverages, and then we operate a business division in New Zealand known as Asahi Beverages New Zealand, and that's a combination of both an alcohol and non-alcohol portfolio. Through this acquisition, we established, as I touched on earlier, a program called Alliance for Growth. So it was very intentionally not referred to as an integration program, because this program is intended to deliver long-term value creation from the CUB acquisition. The program includes initiatives such as consolidating our procurement strategy and our sourcing approach, sharing of best practice, information systems, processes, infrastructure across the group, as well as optimisation of our supply chain network. In addition to these initiatives, we also pursued commercial growth optimisation, looking at things like how we can scale our non-alcohol beer portfolio via our non-alcohol division, and how we can grow our premium international beer category, not just in the Oceania region, but more broadly across the group. We also looked for opportunities where we could remove duplication, both in our people and our processes, and we saw a lot of efficiency. But similar to the comments Stuart made, it was really important that we did this quickly to enable certainty for our employees. And I think it goes without saying that onboarding a business of this size of CUB during a pandemic and whilst in lockdown was quite a challenge. And whilst these challenges existed, I'm pleased to say we were able to achieve our business plans and our Alliance for Growth targets. And I think the success to this was really because we remained focused on our core priorities. And our core priorities are making and selling beverages, but also keeping our employees safe and well. And so we reiterated these messages through a really strong communication program throughout the Alliance for Growth program. And 12 months on from the acquisition of CUB, we completed an engagement survey and scored an overall engagement score for the group of 85%, which I think speaks volumes of having a very people-led strategy, focusing on people during that integration. And one thing now our CUB employees will say about Asahi Beverages is that our focus on people is one of the greatest strengths and therefore one of the greatest success stories of this acquisition. So happy to take any further questions, Chris, but I'll hand back to you in the Sydney studio.
Thanks, Amanda. Terrific to hear those insights. Perhaps if I could just follow up one in terms of something that you and Stuart both covered about people and culture. Is there any particular element of that you as CFO felt you really looked at every day, every week? What was it about that you were really focused on?
I think, Chris, a few things. First of all, I think communication. So being clear on what to expect and when. I think for us, what was really important with people as well was we didn't use the word integration. We didn't, in fact, even use the word synergies internally. It was very much about Alliance for Growth. So it was about the future and it was about bringing the businesses together. So I think those subtle changes in our language meant that our employees felt very much part of the process and part of the future. So whilst there were some obviously changes through bringing the two alcohol divisions together, I think the way in which we communicated that and kept employees informed, given that a lot of them were working remotely at the time, perhaps in many instances the CUB employees hadn't even met any of the Asahi management, it was really important that those communications were clear and consistent. And I felt that we were able to achieve that by focusing on the future and focusing on our growth strategy.
Yeah, terrific. Thank you. I mean, it's actually quite remarkable what companies were able to achieve in 2 years of lockdown. If we had have said to them 2 years prior, you're going to do a major $16 billion integration and you're all going to have to stay in your lounge rooms, you would have just said it's not possible. And yet here we are with almost a change to the employee value proposition from where we've seen it before. Let's make a note. We might pick that up for our next topic in the series. Just a reminder that your bottom left-hand corner is the place for you to get involved and to ask any questions you may have. So happy to bring those up as we go along. And no questions are off limits, but I can't guarantee our speakers will necessarily go each time. So we will move now to the Q&A and get people thinking about each of our panel members and where they'd like to focus on particular topics that they brought up or something else that you felt they didn't cover off as well. I'll direct those questions a little bit towards Clara and Marcus in terms of the broader macro trends and probably to Stu and Amanda in terms of specifics happening down into the nuts and bolts of a transaction. But I know all four people are happy to answer questions at different points in time. So let's throw it open to a discussion and see how we go. First question is actually for Clara, if you're ready for that. How do you think the timeline for synergy realisation has changed in recent years? If the speed of deals has gone up, how quickly do you have to demonstrate that what you put up is going to bear fruit?
Yeah, I think that's a really good question. I think Stuart sort of raised that in his discussion with the broad spectrum transaction, in that achieving synergies, you need to have planned it well in terms of the due diligence process and be really clear on what those synergies are and then execute really quickly. Yep. I think as Stuart mentioned, being clear, communicating with employees is the most important part, and just moving through that process quickly, and then I think everyone can then move on with the growth once that period is over. But having a clear plan and then moving through it quickly, because during that period, it obviously does create uncertainty for everyone. So the quicker you can get through it and the quicker you can show the market that you've achieved the synergies, obviously then they start to believe in the value of the transaction.
Yeah, That's really helpful. What about you, Marcus, the conversation you had around how important it is to keep discipline in the way you approach your M&A transactions? How does Brookfield do that? What do you see as your core disciplines, and how do you monitor that they're being executed?
That's a great question. Thanks, Chris. How we think about this is that we like to stay within our lane and look at opportunities in industries where we have a lot of experience, be it we have a similar business overseas in North America and Europe, or the company we're now looking at is a supplier or a contractor to a company we already own. So typically we tend to invest in areas that touch upon either real estate or infrastructure, because we're such a big investor into infrastructure and real estate. So we like to stick to our knitting. And then when you have identified an opportunity that fits that, you need to be disciplined ultimately as a financial investor like us, that we need to deliver a return to our investors. It's all about where we think this business will go and how we can essentially enable the business and the management team deliver on their vision. Yeah. And based on that vision, what do we think we can pay for this company, and is the company ultimately willing to transact at that value?
Yeah, it's really interesting. Just drawing on experiences. I mean, it's part of what people, I think, use their advisors for. Quite often, you're doing this for a once in a lifetime event for some companies. Where I imagine Brookfield gets the chance to actually learn from its past, learn from its other experiences, and really draw that out. So. Yeah. It's a good call out. Look, the next one's going to go to Amanda and Stuart, but I'll go to Stuart first, and then cross to Amanda in Melbourne. But this is the nuts and bolts for a CFO. It's not that the world stands still while you knock the M&A over. You've actually got the day-to-day operations of the business continuing at the same time. Talk me through how you manage that challenge, that you've got a team to keep focused on the day-to-day, plus you've got to deliver on the M&A, you get people distracted. Tell me how you've sort of dealt with that at different points.
Yeah, it's a very good point. I think, you've got to recognise that it's going to be a drag. That these transactions do require a significant amount of management effort and focus, and just a huge drag on your time personally. So I think, with the rest of the business, the focus on having people which are still running the business, where you can really delegate, you've got confidence in those people, you can't drag everyone in. Yeah. You've got to leave the business set. And it needs to continue to operate. That said, you can't step too far away, in my view. And so all the things that are important from a governance standpoint to running an organisation have to remain in check. And as a result, probably just an enhanced drag on your time personally, but hopefully then for quite a beneficial outcome.
Yeah, great. Amanda, can I throw that same question to you? How do you balance that internal keeping the lights on and the cut and thrust of what's going on in the integration activity?
Yeah, sure. Thanks, Chris. I think not dissimilar to Stuart, when we were focused on the acquisition phase of the deal, people were dual-hatting a little bit, but it really came down to focus. And certainly post-acquisition, we ensured that we had separate people seconded to the Alliance for Growth program, so that program could be set up for success. As I said, it's a longer-term value creation program. And so we made sure that they weren't distracted with the day-to-day. But during the deal phase, there's certainly, it is a bit of a extra effort on everybody, but obviously there's usually only a very small, intimate group involved in such a deal in any event. So we try and keep that quite tight to keep everybody focused on running the core business, and then ensure that integration is got some sole focus as well to make that a success.
Yeah, got it. Thank you. Perhaps this one's for Clara and Marcus, who see these deals coming together. If you think the M&A activity is going to really continue on a strong course over the next 12 or 18 months, what sort of things can our CFOs be doing to prepare for that? What have you seen when people are ready for action when this comes up? Any tips and tricks?
I often then throw over to Marcus. I guess the key piece is just around being truly on top of your numbers, and as CFOs, I'm sure that you are all on top of your numbers, but you can't underestimate the level of analysis and the level of detail that one goes to in a due diligence process. And people will want to look at the business in different ways, potentially to ways that you've not looked at the business. So take a step back, make sure that your numbers are in order, make sure that there is a level of analysis behind your divisions or whatever it may be, in order to give across, I guess, the level of detail that's going to be needed. And I guess every now and then just, take a bit of a step back and potentially get someone to take a bit of an outside sort of in perspective on your business, because you might appreciate some of the views that they have from the outside. Might throw over you to Marcus. What are your tips?
I think you said it very well. I don't have a lot to add. I'll just emphasize being on top of your numbers. When you're into diligence, if people are looking at your business, they tend to go very detailed. So not just the headline numbers. We'll want to go deeper and really understand divisional performance and ideally that numbers should speak to each other, that they reconcile when you actually do the sum of the parts. And if they don't, that there is a clear ledger where you understand why it doesn't reconcile. So that's my key takeaway as well, be across the numbers.
Yeah, and I've sat in some meetings with Marcus where we've had those conversations, where we've worked on a due diligence process, and we've sat there and worked with the finance companies, and when we started to reconcile the pieces, it was clear that they potentially weren't across the numbers as they should be. And at that stage, you've lost confidence. So as soon as that starts to happen, then it's a bit of a slippery slope. So make sure everything is in order.
It's only fair that we give our CFOs a chance to respond, I think. So, so Stuart and then Amanda, anything that you particularly thought about in that terms of preparation, what you might like to do, and anything you wish you'd done? Stuart?
Without wanting to just keep replicating the same point, I mean, there's a lot of work that goes into just building up, not just the numbers, but the story around the business. Because you are ultimately telling a story, you're trying to help people understand where the business has come from, but also, most importantly, where the business is going. And, that story needs to be both coherent, supported with data and detail, but very clear. And, it's interesting, Ventia is a recently listed organisation, but, just the number of investor meetings that you have, and then the thinking about, continually educating people on the business, and it takes time. It takes time to learn a business. Obviously, Clara, that's part of your job, doing that every day, learning businesses, and same with Marcus. But it definitely takes time to bring people on that journey.
Thank you. Amanda, any particular things that you wish you'd spent some time on?
Thanks, Chris. Perhaps I'll talk about, learnings and perhaps what I would have done differently. So I think as part of our deals, we've agreed some principles around activity that will happen post-transaction, things like transitional services agreements, how we'll bring IT infrastructure and applications together, etc. And often post-deal, as you're working through those things, practically speaking, there's a few lessons that are learned that you wish you'd known beforehand, that either, can slow down how you bring the businesses together, can result in, incremental costs, can take longer, and so on. So there's the deal itself, but then there's that intervening period. And I think, a lesson learned is make sure that we continue to understand some of those things up front so we can plan for those appropriately, in any future deals and just, in general business operations.
Yeah, understood. Thank you. While I've got you, Amanda, as you went through the process, anything you identified as skills gaps? So you've now got a new organisation. Was there things that you needed to think about differently in terms of the skills you needed?
From an operational and commercial perspective, not so much, because we're a beverage company acquiring a beverage business, and so the commercial skills and the supply chain and operational skills are very complementary. I think from a finance perspective more, particularly how we aligned the organisations from a sort of systems and process point of view is probably where we had some skills gaps. So people knew how to run the business. People didn't know necessarily how to work on the business. And that was probably the gap that we found, is we needed some people looking outside in as to how to optimise, bringing the businesses together with the best process or the best technology, by way of example, but people couldn't necessarily articulate that as well as they could articulate how to actually operate the process or operate the system that existed inherently in each of the different businesses. So probably learning there is make sure you've got people working in the business as well as working sort of on the business to get the best outcome.
Yeah, great. Really good tip. Look, I think we could go with Q&A for another hour and a half, but we also have busy CFOs online and we want to make sure that they get on with their day. So allow me to just, three things that really struck me as we went through that today. The first was just really being across that detail, that the speed at which this is happening and where things will play out is going to be important, and you can't be ready enough, and you probably won't be ready enough, but it's certainly a high priority. The second one that came up from all of our speakers was the implications that culture can have in how this plays out. And I think it goes to Marcus's point on synergies, that synergies is where the value is going to come from. Synergies are more than likely going to come from people doing great work. And I think we think differently about, is that just heads out the door, or is it actually getting more out of the great people that we've assembled? And I think that's a real maturing of this process over time. And the final one was actually fairly early in Clara's presentation, but just the whole idea that Australia's a bit behind on the whole ESG front, that trend we're seeing globally and what's actually driving M&A, what people are interested in to really drive value, it's going to have a lot to do with the various elements of ESG going forward, and just making sure that's on the radar. I know it is, but it probably hasn't been seen as the deal space as much as it is now. So with that, I'd really like to thank our panel members today. I think it's been terrific. Thank you, Clara. Thank you, Marcus. Thank you, Stu. And Amanda in Melbourne, thank you very much. Martin, thank you for hosting as part of the G100. On behalf of the G100 leadership team, we want to thank everybody for joining us today. I hope you've enjoyed the conversation. And we hope you can join us in early June when we reconvene actually on the future of work, thinking specifically about the employee value proposition and things that you might think about in there. So with no further ado, may I wish you a great day, and thanks for joining us.